Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi everyone, how you going? Welcome to the podcast. Thanks for joining us today as we in lockdown navigate property and property investment. I think one of the benefits or boons for the property markets during this period of time, particularly property investment, is a lot more people have got more time on their hands, locked up, and I think there's half of the nation now is in their bedrooms, in their lounge rooms, in their home offices trying to get business done. There's homeschooling all over the joint. There's a lot of stressed out parents that I'm chatting to trying to balance all facets of their life. But when they get some downtime, everyone's still interested and passionate about property investing. But it's just not the more of us more advanced in age, those sort of doing homeschooling. There's a lot of younger people now really focused on investing in property. There's a big cadre of people who listen to this podcast, younger investors who are right into it, millennial investing, Gen Y investing. It seems to be the hottest ticket in town, and we like to speak on it. It's one of the sort of myths that I like to dispel on this particular podcast, and I'm often able to get younger investors on here who are the first to say that they're happy to compromise some things in their lives in order to try and get ahead for a better and a brighter future. And let me tell you something, if you invest in property earlier rather than later, the longer that you hold property as an asset class, guess what happens at the back end of whatever this life looks like for you when you do choose to retire? It means that you've had property in the game for longer, which I can largely guarantee is going to be worth a lot more should you only start investing in your 30s and your 40s. So we like to have these chats. In the studio with me today is a younger investor. It looks like we're over Zoom. He's locked up somewhere in Sydney. Looks like he's zooming out of, I don't know if that place is even habitable. Jake Whitlock. Is that a rented accommodation? It looks like it probably needs a bit of a coat of paint, mate. Yeah,
it's a share house in Newtown. Moved in about 6 months ago. You can see here that I've got an eye for style, as the Star Wars poster. The number plates are all from the past tenants. So, I've really added my touch as to just sort of, shoving in my stuff in the background here. But
thanks for put a bit of light, like a different light, maybe a couple of lamps, mate. Do you know what you need? You need a lava lamp is what you need. That'll set that off. Get yourself some cinder block bookcases, mate. You make that a right proper.
Yeah, get some fairy lights going, or a couple of smart bulbs, Philips Hue, or some LifeX bulbs.
But definitely. That's what we need. Now, I didn't bring you on here to give you a hard time, mate. You are a property investor, yes or no, Jake Whitlock?
Yes, correct. Correct, okay. Phil.
That's good. So you invest in property. That's good. That means you can come onto the show. How old are you, mate? Just so our guests get a bit of an understanding.
23. 23, Phil.
23. So young. So you're living in a shared house in where? Newtown?
Newtown, yeah, that's correct.
For those out of New South Wales or Sydney listeners, Newtown is inner suburbs of Sydney. It's probably only you could probably walk to the city from Newtown if you're up for a bit of a hike. Probably 3-4 k's, I would imagine.
Yeah.
Not far from central, vibrant area, lots of pubs. You're not allowed in them at the moment. Heaps of restaurants, nightlife.
I don't get in anyway.
It's a perfect spot for a 23-year-old to be living in. Lots to do, lots to see, no doubt. So how long have you been there for?
About a year, I'd say.
Okay.
6 months, something around that.
Yeah. So you've moved in. You've just left the same posters on the walls, the same number plates on the wall. Just put a bed in there and went, this is where I'll sleep.
Exactly. Just keeping myself busy. Too much to do. Too entertained to think about those things. But yeah, thanks for having me on, Phil.
No, it's great. Look, I love getting younger investors in to dispel the myth that property is impossible to get into. But no doubt there's been a lot of compromise for you, and probably a whole bunch of things that you've gone without. And no doubt, if you can give us some of your insights, and we'll get into it on the podcast around how you've been able to raise a deposit and all that sort of stuff. So I assume if you're able to rent in Newtown, and I assume if you're able to invest in property, you have a job. Is that correct? That you can work from home in?
Yes. Currently working in software sales. So been sort of working in sales for the past 5 years. So yeah, currently employed.
And sort of what got you into sales? What's the sort of backstory with that?
Well, really, I messed around in high school, just wasn't really very sort of academic or even driven. Didn't really go to university either. The sort of, for someone who's like 18, 19, aside from sort of, coding or technology stuff, if you're not going into higher education, sales is really the sort of only place to get sort of a leg up and start your career in terms of from like a monetary standpoint. So that's sort of what sort of drove me there. And it's been a huge sort of learning experience in both sort of developing like social skills, understanding how businesses work, what revenue means and how you can impact and influence revenue, and for the services you sell, influence other businesses as well. But yeah, so that's sort of what sort of brought me there and sort of led me here. I guess to start off with, I might talk about sort of what led me to invest in property over other things, which are common, like cryptocurrencies, stocks, ETFs, the typical stuff which young people are drawn to.
Yeah, and that's a really good point. And you've invested in direct property, which typically means that you need a fair wad of cash behind you, whereas other people, your peer group, those in their 20s are probably investing in REITs or crypto or sort of share-based stuff, because you can get in there with $500, right? Like you can start investing at a lower rate. So you're obviously attracted to property, but on the sales side, so you've been drawn to sales. Sales has been an enabler for you to generate income, and no doubt compared to your peer group, if you can share with us how much money you earn, I'd like to know. But you're probably making more money than other people who might have gone to university and now are only sort of starting their first job.
Definitely. We're in the age of information, right? What that means is there are certain B2B purchases and products which you can sell, which are in effect infinitely scalable with the internet, thankfully. This means software, it means advertising, it means media. So what that means is for the business, when you're working with a customer and they want another advert or they want another piece of software, is the things which I'm familiar with, there is no freight cost, there's no shipping cost, there's no underlying cost, right? A big cost for the business is acquisition for these businesses. It's developing that relationship, and through the value drivers of media, events, software, they have a high ROI for the end user. And what this means is that you can grow these accounts, and the businesses that as a sales rep for me work for, they don't actually have to increase their cost in sort of providing more for the business. That's very high margin, the growth. And what that means, thankfully, for salespeople is with these businesses, particularly ones which are focused on growth, is that they're willing to pay a lot more for that growth. I'll give you a more generous margin of what that means, especially in this land of 0% interest rates and venture capital and this sort of software boom, where these businesses are really focusing on getting the right metrics to raise another round of funding. So what this means is that they will pay salespeople a lot of money to help them achieve those goals.
So that's a roundabout way for you to say that you work in software sales and you get paid well to sell software, correct?
Yeah.
Okay.
Yeah,
do you
totally.
enjoy selling software?
It's the next thing. If you're sort of young and wanting to get your toe and get some professional experience, media sales as well. It's I couldn't rate it high enough.
That's cool. That's good.
As an alternative path.
So it sounds like a good experience. So you didn't really tell me how much money you earn, so that's okay. But no doubt, I imagine you're getting paid quite well if you're able to invest in property. So sort of in terms of asset class, a lot of younger investors aren't attracted to direct property, mainly because number one, you need a stable job that generates reasonable income. But I know people who you can invest at pretty much most levels. But number two, you need to be able to raise a deposit, and the bank needs to be comfortable that you can service debt. So for a lot of younger investors, that sort of puts them out of it. But it is possible, right? You can do it.
Oh, 100%. So I don't mean to hide away from how much I make. It's about $200K a year. Okay. I'm sort of like my fifth year into software sales.
That's not bad money for a young bloke at 23.
Nothing to complain about. Very, very fortunate to find a business which rewards people for their hard work. I would say for sort of people who are sort of maybe younger or aren't familiar with the business, or are maybe earlier in their careers, something around sort of the 70K year one is sort of what you could experience in sort of a selling role. And I'm sort of like about 3 to 5 years you could be looking to make sort of similar money as you sort of build your experience. But yeah, so in terms of like the cash flow and things like that, working in sales, I sort of always had a bit of money to play around with. And as ultimately an idiot 18-year-old who was just interested in making high-level bets, I wasted so much money, probably over $50,000 on the stock market, burned myself on cryptocurrencies, burned myself on CFDs, just ultimately thinking that I was smarter than the average when I am below average on the median, like below the median average. Essentially, I'd been sort of like warped to believe that, 8% returns, 10% returns was like, that's like, the average market. But the truth is there's a median return, which is even lower. And that's for your average sort of punter. I'm probably bringing that down with my performance. Ultimately, I was originally a property bear. I thought that property, wrongly wasn't producing value for sort of a wider community. I thought that, I read into, this is back in sort of like 2017, news media about over leveraging and, watched The Big Short too many times and thought that there was some sort of, scheme or there was some sort of risk involved in, or overemphasized the risk that was involved, and looked to essentially prove that I was smarter than everyone and tried to pick which companies are going to do well, reading and doing analysis on sort of like Hot Copper and other sort of nonsense garbage stock reading forums where businesses are just paying people to lie to you about sort of the metrics and, are focusing on sort of investing in all these other sort of dodgy lithium battery companies and all this stuff, right? And effectively what I learned and how I thought of it was, it's like, all right, I've lost $50,000. I've probably spent 1,000 hours worth of research. So I've lost 50 grand, spent the luxury of $50 an hour, losing this money, doing this research, trying to figure out what's worked. I've actually looked on the other end, and there have been 3 things, property included, which are a lot simpler and have been the only things that have worked for me. And I've decided to take another approach to simplify things. And that's sort of where it led me to property.
Jake, it's really refreshing for you to talk that way. And you should be congratulated, mate, how you've gone about, shaping your own education towards an attitude towards property. And, the job that you have, you're doing well, mate. And that's, it's good that you're doing that. And, no doubt there's probably a whole bunch of other listeners your age who would like to emulate that. But you talk about sort of dusting 50 grand, investing in all this sort of stuff. But I reckon it's probably the best $50,000 you've probably ever spent. A lot of kids would go away and probably drop that, in a university education, mate. And you come out of that with just some, you read a bit of Plato and Socrates and stuff, and maybe an arts degree, mate, you've probably got one of the best educations that are out there for your $50,000, which will not only sort of transform your way in which you can grow and evolve as a professional. And you told me your income, mate, you're doing well at that age, but no doubt there's some rigor and some discipline behind it as well. So, mate, frame that as in the best 50 grand you've ever spent. That's your university education, mate. And it's probably going to hold you in a lot better stead than those people that chase those academic dreams.
Look, losing that kind of money early, I'd rather lose it at the start of life than at the end of life, right? I'm sure
a lot of people blow their money in their 50s like that, right? When they just go, oh, wow, retirement's knocking on the door, I better hurry up. And the more you hurry up, the more you risk. And if you're doing that in your 50s, it's a lot harder to recover from it. You do in your 20s. I've probably spent 50 grand on drinking and traveling, right? Which to me, when I traveled a lot my 20s, had some great experiences. But mate, that's the best investment I've ever made.
Yeah, totally.
Courses for courses.
Yeah. I mean, there's a number of things I could have spent that 50 grand on, probably a couple of European holidays and something. Ultimately, when it comes to investing, everyone wants to be that guy, the guy that, bought Zip when it was, 8 cents, or Afterpay when it was $6 during. Everyone wants to be that guy. But the thing is, for every one of those people, there's 10, probably 20 other idiots like me who are on the other end of, guessing this stuff. They've got, fleets of nerds doing mathematics, working in hedge funds, doing that stuff full time. For me to arrogantly think I can do an hour or two a day and try and beat the average is, foolish, really. So it's something which I've learned, and I'd rather learn it early than late. And for anyone listening here, skip
Get started early.
Trust me.
Get started early, and it's that old adage, Jake, of you might not have necessarily liked the lesson, but it was a good lesson, and now you're sort of firmly focused property as an asset class. Mate, really good to hear how you're performing professionally in the workplace, mate. That's really good to see you excelling at such a young age, and hats off to you for that work. But let's get into the you as a property investor. We'll go to a break beforehand. Just reminder everyone, the Smart Property Investment, you've been tuning into the show for quite some time. You know that we map our own journey. The spreadsheet that we use to help support understanding our portfolio, it is available. You can download it. You can go and check it out. It's just the Excel spreadsheet that we've glued together to help us understand our portfolio. But most people who have seen it reckon it's not too bad at all. So we're making it available to our listeners. You go to the smartpropertyinvestment.com.au website. It's a big thing at the top where you can download it. Enjoy any questions at all. You can ask the team, which comes through to me, editor at smartpropertyinvestment.com.au. Stay with us. We're going to break. When we come back, Jake Whitlock, the property investor, back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Jake Whitlock, 23 years old, investing in property after a pretty good education, investing in other asset classes. Now, Jake, one of the biggest hurdles that most young people, even sort of all property investors, the biggest hurdle getting started in property is being able to raise a deposit. So, mate, how did you go about ponying up enough cash in order to get in that first property? And we'll talk about the property in a moment, where you bought it, what it is, how you got, but how'd you raise the money, mate? You must have gone without, were you sort of drinking to his new instead of craft beer and, eating Maggi noodles rather than Fargois? Yeah,
definitely. Look, I think having sort of low taste is something which is important when it comes to, going without, in a sense.
Mate, I can see your bedroom. For a bloke earning the money you're earning right now, it looks like you
and they talk about happiness being things that you're content with, right? And
absolutely.
Being content means being happy with the simple things in life, good friends, close family relationships, having a simple life, I think, is something which is undervalued. You don't want to be stressing about, expensive cars or expensive clothes, ripping up your new $1,000 shoes and your night out. Like, these are things personally I prefer to live without. And the excess sort of, funds, I just use that to sort of, risk proof my future. I don't see this as some sort of path to greater luxury. Personally, I think it's just more sort of mitigating risk in the future, and, purchasing property, saving money will, work itself out in the end. There's not necessarily a clear vision of, I get this and, I'm going to make it. It's more just sort of focusing on being content with what you have, and, living that sort of simple life. For good 4 or 5 years after high school, I was happily just, I lived with my parents for a good, until I was about 22. So I've been moved out for 1 year. So that is definitely a sort of a luxury. Not everyone gets the opportunity to enjoy. So if that's an option for you, and property is something, or investing in wealth is something, you can definitely save $15,000 a year in rent. And, if you think about it post-tax, think of it this way: $1 saved is $1 earned. And, if you're getting taxed at 30%, 40% with your money, it works out in some cases where it's like it's easier to save $10,000 than it is to earn another $20,000. So, look to enjoy the simple things, and focus on, the things that save you time as well.
When did you start actively saving up money for the purpose of getting a deposit together for property?
I guess that was sort of a journey which started around about 18 months ago. Thankfully, I did have sort of access to funds which allowed me to sort of start sort of looking at options. That was about 18 months ago, and it really was around sort of using ASIC's compound interest calculator, using an expense calculator, and then using the website paycalculator.com.au, using a combination of those sort of three things. I can't remember, I think it was Pocketbook was the app which I used to manage my expenses. I looked at, what was sort of my monthly earnings, what was the amount post-tax that I was getting, what were my expenses, what could I cut down on, be that sort of like video games, be it on nights out, be it on sort of luxury items and like Uber Eats, focus on cooking, things like that. And if you just haven't done that, that's one worthwhile exercise. You do sort of realize when you're seeing you're spending, $1,000 in Uber a month, that's a pretty big wake up call. So, working backwards, so seeing like what's my expenses, what can I control, what will actually be, fun to do, like cooking, for example, was something which I've actually enjoyed and saved money on. So working back on sort of using like Pocketbook, looking at Pay Calculator to see, post-tax, what I could, what I had and what I could work with, and then using the ASIC compound calculator more as a motivation to see, in 10, 15 years time, what could this mean if I saved this much, and how much could this impact my future as well?
You proactively put quite a lot of structure around the outcome you wanted, and that was to save money in order to buy a property. How did you stay the course through that? Did you sort of, wobble at any point in time, or let yourself down, or overspend
Definitely.
anywhere, or how'd you balance it?
Like all my investments so far, I think with property, I've definitely made some mistakes already as well, right? Like, but I think, and this is with experience, don't try and buy at the very top. Don't try and buy at the very bottom. It's an over time, like time in the market versus timing the market, right? So with sort of the property that, I sort of took my learnings from, trying to pick the best stock or trying to do my own research. I sort of took a step back and I thought, how much does like a buyer's agent cost realistically? Like what's sort of the investment in having someone else professionally that does this help me make the right decision? And if they pick the right decision, what in terms of annual gain would that be to if they choose an option, and I work this out, effectively, if their option increased over time, just 2% more than an option that I picked, their option would pay for itself. And then anything above that is immediate gain. So if they picked an option which was just 2% below the market price, they've immediately paid for themselves in that sense. And not only that, I spent 1,000 hours on Hot Copper, other sort of research, trying to pick my stocks. And with using a property buyer, I've wasted effectively 0 hours picking out and identifying, which state, which suburb, which market's hot, what's the block land, what's like the rules around development, how are things changing, demographic. I haven't had to do that research. And, that's a big chunk of time to do your due diligence on these things. So, if you find a trusted party, that has strong reviews and, you talk to and you have that sort of right relationship and you trust them, that they can save you a lot of time and help you make an investment that is right for your risk profile and also your objectives as well. So thankfully, I went down sort of the property buyer path. And even in that path, I still made mistakes upon reflection. First mistake really was they presented one option. First of all, this was back in November. And I think it was just, first time nerves. I wanted to read the contract in more detail. I didn't really understand everything. I wanted someone with a bit of a law background to look at it. Upon reflection, cost me in gains tens of thousands of dollars again, because that was just right after the huge upswing that's occurred, in this period of time.
So you weren't in the market, and therefore you've missed how many months of upside benefits should have you made that decision to go ahead then?
Correct.
Yeah. It's good to be reflective on that. And I want to get into the sort of properties you purchased, but Sort of a message from you, Jake, to, I guess you're a millennial. Are you a millennial? You're a Gen
97.
Yeah.
Zoom. I think that's on the cusp of millennial, end of the millennial to the Zoom Generation Z
the
or whatever.
Zoom generation. So you're a young investor, mate, and congratulations getting into it. But you don't subscribe, or I'll frame the question the other way. Does your peer group know you're now a property investor?
Some people do. Some people do.
Yeah. And do you all sit around on a Saturday night, just do and watch people in their 20s do, which I've done a lot of time, just hanging out, talking crap and drinking beer? Does everyone lament about how, they're never going to be able to buy property? It's so unfair in this market. Yeah. Like how much currency has that got within your peer group around where the stuff generation, because we're never going to be able to get into property?
It's an incredibly valid, well-spoken sort of conversation in a sense, and it's something which I shared a perception of for a very long time as well, is, and I think it's about shifting perception is like the most important thing, where, I grew up in the North Shore, where, the average house price is north of, $2 million. And, with my peer group and me, there is definitely sort of a consensus of, we're not going to be able to afford to buy ... where we grew up. So it's important to sort of shift perceptions and understand demographically what's happening in Australia and what the future of Australia will be. Places like sort of, the inner city and places like this, which, sort of like top rated cities in line with, San Francisco, New York, Hong Kong, Sydney is going to get a very similar multiple to the average salary to what the house price is. And that's probably up to the 20x. There's places in China which have 50x. So there is a very high propensity for things to go in that direction. Ultimately, property is tethered to the price in which people are able to afford. And as much as people complain about, affordability, I mean, someone's buying these houses, right? So there's some sort of validation. I think, everyone still just, ultimately values what someone else is willing to pay. And, I think as a salesperson, if your customer is complaining about the price, you're probably billing them the right rate in a sense. So to sort of, I guess, like talk about sort of like a younger person perspective, I'm not necessarily focused in like buying in Sydney. I'm not necessarily focused on like living in Sydney all my life. I think with sort of like the information age, we're entering a more transient society as well, which will mean moving to different places around the country. It will mean sort of, making investments, real estate investments outside of Sydney as well. Sorry. So what that means is for me, I did not look to buy somewhere in Sydney, for example. It's outside my profile. It's outside my ability to get, leverage and access to finance. So I looked to invest in somewhere which was also another emerging market, somewhere which will continue to grow over time. And, there's a very valid strategy if you want to stay in Sydney for building your family in, is to invest in other Australian markets and rent those out to allow that to subsidize or completely fulfill your rent in Sydney as well.
And there's a lot of take from that from the younger investors. It is a mindset shift. Just don't think your paradigm for your parents' relationship with property and where you grew up needs to frame how you need to go about doing it. And you find a lot of people just have a light bulb moment where they sort of understand and get it. And I want to get into the property, Jake, but go to a break. But before we do, Han, like for you investing in property, like what's the sort of fundamental outcome for you in that? Is it just to give you, start on a wealth journey, and what are you going to do with it?
Yeah, totally. I think with every sort of investment strategy, you have to have sort of like an understanding of like what your objectives are and what outcomes you're looking for. When it comes to a property, when it comes to sort of investment portfolio and managing risk, having an access to leverage is one of the most alluring things about property as an investment vehicle. The ability to, essentially balance and leverage existing funds. So, for example, and I guess we'll get this into my property in a bit, but around sort of, multiplying your initial investment by, 5 to 10x versus having that in the share market and getting 8% or 5% there. For me, it's a negative percentage, versus juxtaposed to in property, where you're getting a consistent cash flow, you're getting equity in a vehicle, and it's appreciating in leverage, and you're getting the tax benefits. And today, and these are the lessons that upon reflection, I probably should have done a first home buyer, Central Coast, just gone hard with this, was all the superannuation and other government incentives. And there's multiple ways to interpret that. For me, I interpret that as, with COVID right now, we're really having a complete sort of, the tap is pretty much hardly fastened in a sense around immigration. Australia is a country which has, compared to sort of like the US and the UK, it's about like 1.6% annual population growth. I think the US, the UK are around 0.5%. So Australia is growing a lot faster than comparable markets. What this means is that immigration is something which is going to be a big proponent of property appreciation in the future. So thinking about investing in markets which will have more of an appeal to immigration. So where I purchased my property was in Perth, Western Australia. And a big part of sort of what was an influencing factor was, I was born in Hong Kong, and right now there is the handover taking place between sort of the Chinese government and sort of the 97's already happened, but effectively because that shares time zones there, and it appeals to the Hong Kong population to migrate to Perth, or is one of the options in staying to the same time zone, for example. So it's somewhere which really appealed to me. But I guess looping back to sort of like your primary question, the leverage is something which is really appealing when it comes to building out and scoping a portfolio around wealth creation. I guess, Phil, one question which comes to mind for me, I'd like to find out, maybe pose to those who are more experienced, is what do you feel is the right ratio of assets to leverage? Is that, so like currently I'm probably on like a 2x, like my debt is probably equal to my net assets, if that makes sense.
Yeah.
Is that am I under leveraged? Am I over leveraged? What's your thoughts?
It's a good question to ask, and I'm not in the business of providing financial advice, but I'll chat in general. And I've spoken to a lot of property investors over the years, Jake, and the one thing which I would say is universal for all effective property investors I know is that they'll say, I wish I bought more property when I could, when I was younger. So maybe you need to channel that. You're fortunate, you're still young, you're doing well. It sounds like your professional career is only going to grow and expand. And you put into the context of, like a retail super fund for most workers. When you're younger, retail funds or industry funds will put your money in riskier assets for the purpose of accelerating growth. And then as you get older, they'll dial it down into more protective assets. So in many ways, the same thing applies for property investment. If you're young and you have the capacity, you should be making hay, because if you're informed about your decision making, you should be largely be able to do it quite well. But you know what? If you bet the farm on it and you dust all your dough, you can still start again, right? So you speak to most buyers agents, most sort of property strategists who can talk a lot more informedly about that. They'd be going, if you can put the pedal down now, put the pedal down. And, in terms of portfolio creation, you got to create the portfolio before it sits there and stews to a point in time that you sell it down. So if you can do more now, I'd probably give it a red hot crack, but you need to go and speak to someone that actually knows more about that than me. But let's talk about the property. We'll just go to a break beforehand. Back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm chatting with Jake Whitlock, who gave away that he's investing, or his first property is in Perth. Tell me about the property. So you could have bought in November, you didn't do it, and you waited until when to buy this property? Where is it? What is it? How much was it? Yeah,
great question. So it's in Perth, about sort of 40 minutes from the CBD in a suburb called Gosnells. I hope I'm pronouncing that correctly. So that's sort of, I guess, the region that I purchased the property in. It was, I bought it in, I would say, between March to May is like sort of like the purchasing cycle of like, signing off and final payout to sort of, I'd say March, I think, is the right time or correct date So I purchased it in March for $330,000. So on the sort of low end, when you compare that to the Sydney market, I had a deposit of 10%. So that's like a $35,000 deposit. Total fees with the buyer's agent, stamp duty was sort of around the mid 50s, I'd say. So around 55 to maybe 58,000 when you factor in sort of conveyancing and the trust management and all those sort of things as well. So it's about $58,000 for the initial purchase for 330K property.
Okay, and so a house on land, 3 bedrooms, 2 bathroom, pretty standard sort of stuff.
Yeah, three bedroom, 1 bathroom property. It was on sort of like a 662 square meter lot of land. So the property effectively could technically fit another 2 houses on the entire land. The property, funnily, has almost like there's 1 house on it, and then there's like a big fence, and then just like this vacant lot, essentially, where you could build another property. It's not necessarily something which I'm going to entertain, but in the future, this will, for development, or if there's a property syndicate or something along those lines, it's something which will add further value just because of the ability to do so. In addition to, that does lead further options. So right now I'm on an interest-only loan, which is positively leaves cash flow positive based on the monthly repayments, which is around sort of like $850, and the gross rent's about $1,050. So I'm getting about $200 a month positive after all the fees and things as well from the property manager. So with that, I do have the option in 5 years to refinance, or even earlier if I want to stick my broker, and make a decision to best manage sort of the equity that sort of grows within that, and also look to see what sort of options, if that appreciates 30, 40, or maybe like 20%, 30% over 5 years. That's $60,000, something along those lines, and could afford me to purchase another property or something like that as well, as an example.
So you've used a buyer's agent. It sounds like it was a pretty positive experience. We chat to a lot of buyer's agents on smartpropertyinvestment.com.au. I use a buyer's agent myself. Who did you use?
I used Paul from Pure Property Investment.
Okay, yeah, Pure Property Investment. And in hindsight, you would do the same thing again, or you wouldn't think about doing it yourself? It sounds like you've done a mental calculation about the value of using a buyer's agent over doing it yourself. And for you, it was more about getting in the market potentially sooner, but then also paying for their expertise. But mainly as a time constraint thing, right? Like getting someone that knows what they're doing, do it as a full-time job to do the work for you.
Absolutely. I'm like, upon reflection, I was probably a pretty frustrating customer to deal with for Paul, because he gave me one option earlier on for, I think it was like higher, it was like 450 or 440 or something like that, right? And I turned it down. The reasoning behind it was ultimately just with it being sort of like a big number, being scared of a big number and making a wider commitment. And upon reflection, I think if I just sort of, threw myself in more confidently, I would have had a better outcome through, the surge in capital appreciation. And I would have also had, and like, I probably wish I did have a higher exposure to the property market at this point now, with a 330 juxtaposed to like a 450 property as well. So Paul did an amazing job managing my nerves and working through.
Don't worry, mate. I always say I'm the most difficult customer is, and it's purely because it's just hard to get a hold of and all this sort of stuff. But to the point, surround yourself by people who are a lot smarter than you are, and specialize in the areas which can make the biggest impact. So that's good sage advice from you, Jake, for other people who are down that pathway. But to be fair, you can do it all yourself as well if you want.
Absolutely.
To spend all your time looking at property rather than going to the Marley Bar and having a schooner. Did I get that right? Marley Bar at
that's
Newtown?
correct.
Yeah, good boozer. Right, mate, that's good, Jake. I've really enjoyed chatting with you, mate. I think, and no doubt we'll get a lot of feedback with this, but I'd like you to be reflective of what can be possible for younger property investors. You can get in the market. It's about shifting your mindset. It's maybe changing your paradigm, understanding why you want to be investing in property and the benefits for investing in property sooner. But I guess the key point would be around the discipline. It's just not going to happen. You need to actually orchestrate it, and that is orchestrating how you go about living your life so you can raise money, save a deposit so you can get in the property. And that there is the key thing, mate, I would imagine.
Absolutely. So just sort of repeating there, the three tools I used was Pocketbook. It was the Asset Compound Interest Calculator and paycalculator.com.au. Great way to start off with assessing your finances, to beginning to understand what sort of, money you can save. And then I recommend reaching out to a mortgage broker to get an understanding of your ability to access capital. So you can understanding of what is a healthy range of risk for you. The broker I used was Finney. So check them out, as I gave them a review online, and have been really helpful with sort of recommending what can work, and interest only versus principal and interest and all those sort of details. So yeah, I recommend start off with the tools, educate yourself to set a foundation, talk to a finance professional to understand your propensity and risk profile, or risk profile from a bank's perspective, so how much you can actually borrow, and then talk to a buyer's agent to understand. Talk to someone who's smart about the market, and if you want to save time and you're confident that their recommendation can net you 2% more, I recommend go with them. If you want to more, if you're more interested in cutting it your own, and talk to them anyway to get at least your understanding of what to look out for. They're
really, really good tips, and we'd like to chat on this particular podcast as well. Thanks, Jake. But I'd probably add to that is that there's a whole bunch of sort of sayings around it, but you are reflected by the people that you hang around with, right? So you need to make a choice as a property investor, whether or not you want to invest in property, or whether you want to spend every single cent that you generate for a living, and you need to make that decision. And Jay, you've made a firm decision to save and plan for a future. But if you want to go and burn all your dough, go away and burn all your dough. That's your prerogative, and that's your priority. Go for it, but you 100%. Can't have both. You can't have your cake and eat it too. To my point, maybe this is one of your tips, and you could do something for us. Is I did my education. My education was blew a lot of money traveling and doing whatever. But I tell you what, I can live without much, and no doubt you can cook potatoes or Maggi noodles 50 different ways, mate. You're not having what is it, smashed avocado and all that sort of stuff. What's the meal of choice for a budget conscious young property investor, mate?
There's a bowl they do at Woolies, bags of stir fry mix. It's 4 servings. I just eat the whole thing. It's $3.50. Don't worry about adding any meat. I choose a healthier option to go all veggie. And I cook that up for lunch. I'll probably do it lunch this time. It's delicious, very healthy, and very filling. And
how much would you spend on food a week, you reckon, or a month?
So porridge for breakfast, that's 80 cents, $1 per meal per serving. Probably less. You get $4 to 10 sachets. Lunch is stir fry or sardines or tuna or something like that. And then dinner, I'll probably increase to about $10-15. Maybe take a takeout, something along those lines.
Okay, that's cool. And what's your beer budget? You just drinking the crap stuff?
Got a tin here of Melbourne Bitter.
Okay, yeah, great. I like a Melbourne Bitter. That's good, Jake. But mate, keep the dream alive. You're the new pin-up boy for me on young property investors. So go away and do it. And you got some tips there from Jake Whitlock. But you know what? It goes back to, if you want to do it, you can do it. If you don't want to do it, don't do it. Your choice. But don't subscribe to this idea and maybe of your peer group saying you're never going to be able to get into property. It's impossible to get in the property, et cetera, et cetera. Jake here is an example that it is possible. And it might not be starting in your backyard. Jake's invested in Perth, which is some way away, but no doubt over time that will be a good asset. Jake Whitlock, thanks for your time today, mate. I've really enjoyed it.
Phil. Thank you very much. Have a nice one.
Hope you enjoy that, everyone. Any other younger property investors and your mates as well, Jake, let's get them on the show. You reach out to the team here, editor at smartpropertyinvestment.com.au. But for the younger punters, you probably want to do direct messages. You can find us on social media, Smart Property HQ. And a quick favor, Jake, I want you to do it straight away. If you listen to this and you like what we're doing, can you leave a review on the podcast player that you're currently on? No doubt most of you will be on iTunes. Leave us a review. It's just not me here who gets to do all the good stuff about the show, and that's chatting to inspirational young investors. There's a big team here who make all the magic happen, and they get a real kick out of those positive reviews. Any questions at all, happy to answer them. Is there anything we spoke about today you don't necessarily get or you like more info on, get in touch as well. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.